Hi, I'm Brad Dunn, Key Relationship Manager and part of the Relationship Management team here at Westbridge Funds. One of the biggest parts of the Key Relationship team is, of course, offering opportunities up for commercial, residential, property funds and everything in between to all our great investors. But another part a lot of people aren't aware of is we're always fielding questions around how the economy and how the inflation rate and everything's going to impact our funds, how they're performing, and well, we're getting a lot of those questions right now. So I thought I'd bring along Mr. Damian Collins to answer all those questions for me. Welcome, Damian.
Good to be here, Brad.
Excellent. So let's start with the biggest one that I'm hearing, which is about interest rates and inflation. What is our internal house view when it comes to that?
So look, it's been a pretty rapid rise in interest rates that we've seen over the last 14 or so months. If you go back and look at even the bank forecasts some 18 months ago, no one was forecasting they would have gone up this quickly. So
2 to 6.
So it has certainly had some impact on the economy, and that was the whole point of it. It's meant to slow down inflation, and we have seen that inflation come from very high levels, starting to come back on a quarterly basis. Not yet annual, but starting to come back on a quarterly basis back into towards that target band. So we feel optimistic that if we haven't hit the peak, we are only about one rate rise away from that. And I think there's general sense that out there in the market that that'll be the case, and that's certainly good. That from an investor's point of view, they know where the lay of the land's going to be, but also from an economic point of view, I don't think it's done huge amount of damage, if any, particularly in Western Australia. Western Australian economy is going very strongly, housing strong, and supply is low, so house prices are still rising. East Coast has rebounded a bit in housing. Retail and some other sectors have softened, which we needed them to, because that's going to keep that inflation down. But yeah, look, overall, it's generally going to be a modest downturn. We're certainly seeing what we think is close to the peak of the rate rises, and that's certainly good for housing, and also the commercial property sector gives people confidence to make investment decisions.
100%. One thing I am getting asked though is also from a much bigger perspective, the global economy. Some people are suggesting that China's going to stop buying iron ore from us, and the US might go into recession. What's your thoughts there?
Oh, look, it's certainly something you've got to be cognizant of. We, in Australia, and particularly Western Australia, we are subject to what happens in China, and it's a big part of our economy. Interestingly, their inflation rate's gone back to nearly zero. So they're at the other end of the spectrum. They're now starting to look at pump priming their economy to get things going back on again, which is actually not a bad thing for WA and commodities, because it means that obviously iron ore they buy a lot of, and a lot of our other commodities particularly they buy also. So could we see a recession in the US? Potentially. Could we see a recession in China? Potentially. They're all things that we need to factor in. But having said that, what we see today, if there is any recessions, they're going to be relatively minor. And a lot of the Australian economy particularly, and in WA, is really transitioning to more of the long-term global commodities that we're starting to see. Lithium is particularly strong. And obviously copper, which is more an eastern states commodity, but nickel here in WA. So there's a lot of, when I speak to people in the mining sector, they're all doing their numbers based on what's going to happen in the next 10, 20 years, not what's going to happen in the next year. So everyone's very bullish and optimistic about the long-term future of Australia and Western Australia. So yeah, could we see a global recession? Yes. Will it be deep? I don't think so, and it might be 6 months, but I don't think it's going to have a huge impact, because a lot of this forward planning is done for 10, 20 years, not what's going to happen next year.
Oh, great wrap up. So I guess the next question is, how does that relate to our funds? Let's start with the commercial funds.
Yeah. So there's two parts to it. Firstly, when we've got commercial funds, we're concerned with and assessing, well, what's the viability of our tenants that sit within those particular funds and the businesses that they're in. So good news is our funds are 99.9% occupied. So look, we're sitting at a good spot. The tenants are generally in good shape. We don't have a lot of arrears, for a couple of small tenants, but that's common when you're managing a portfolio with some retail and small tenancies. They sometimes get in arrears, but overall The tenant portfolio is in good shape. So that's good. And we also have a lot of industrial property. And that's been the other thing that has been a good choice for us and for our investors, meaning that we aren't subject to those retail sectors, particularly over east, where they're getting really hard hit by the interest rate rises. So fundamentally, the assets are in good shape. We've got the right asset pool that hasn't been hit too hard by the change in the yields and the change in values. In fact, our assets are holding up very well. And our tenant mix is good also. So the other side to it, of course, is the cost of debt, because our funds commercially generally hold roughly 50% debt. It'll be plus minus depending on the particular fund. Yeah, that's certainly been a little bit. We did put in place some hedging in some funds, and rates went more than we thought. But all our funds are paying distributions where that's part of the fund strategy. We had to trim a couple just a little bit, but they're still paying very strong distributions. So overall, the impact has been pretty minor overall. And from a residential point of view, our residential projects and funds are based here in Western Australia, and they're still going well. The sales prices are going very strongly. The big challenge we have there, as we've spoken in the past, is construction costs. But certainly from a sales point of view, economically, that's not really having much impact. And the debt within those developments is up a little, but the sales prices and construction costs are a much bigger impact on the overall return for those funds than interest rates in a development project.
Yeah, 100%. And so what about from, say, an acquisitions point of view? What are we looking at? You know, I mean, you mentioned, getting a good portfolio of industrial, but is there anything else from the acquisition side?
Well, certainly when the interest rates were that Reserve Bank rate was at 0.1%. We were very cautious about some of the prices that people were paying out there in the market. There was people out there buying assets with a 3% yield in front of it, 3.6, 3.8, low fours was very common, and we just stuck away from that. We just said that's not economic sense. We knew rates were going to rise again. So it's made it more challenging. Look, we have seen some vendors come to the party, and they've adjusted their prices, but importantly, because we've been very focused on industrial, we are able to, in a lot of cases where we do buy assets in the near term, the rents that may be under that lease could be substantially higher. So once it gets reset to market, so all those things come into play. So it has made it a bit more challenging to buy good quality assets at fair prices, but overall, we're still finding that we can find very good assets at reasonable prices, which you probably couldn't get 2 years ago. I
agree, 100%. I can think of a couple of examples, like your Brabham asset, for example, and that you've managed to buy that has given you that ability to get that future growth, but also keep that income.
Yeah, and so we're buying assets now that we couldn't get access to in the 6%, 7%. That sort of range. Brabham was in the mid to high sixes by the time we settled on that one. That's a net return. So that's you wouldn't find them in the marketplace if you go back 18 months. So that's good overall for investors, particularly when they've got strong tenant covenants like that, a particular asset, and good solid rent growth in those leases.
And I guess that brings us straight into the diversified funds, which are probably the bulk of where a lot of our investors put a lot of money into, because they are quite large funds and diversified. They really hold that benefit, don't they? That diversified approach.
Well, that's it. That's the diversified funds, and we've got 4 of them now. We're on to our 4th one. And what investors like and what we like about them is that ability to spread the risk around, and so that we're not all our eggs are in one asset or one tenancy. We've got assets across the country, across different tenancy sectors. Yes, we have focused very much on industrial, which is because we still believe that's the best sector for growth in the next couple of years, and neighbourhood and local service and a retail as well. That's our areas that we think will do best. So diversifying the asset pool, diversifying the locations, diversifying the tenancy, that's worked really well, and that's, even though interest rates have bitten a little bit, as I said earlier, that still allowed us to get out there and start to build that portfolio of assets. And in diversified 4, we're at that circa 100 mil range at the moment. We've got a little bit to go, and we'll continue to work hard for our investors to find those good last few assets to round out that fund.
Works to our benefit. We can buy yielding ones that will help to improve it. So that's fantastic.
Yeah, absolutely.
I guess that brings me into one of the biggest things that the investors are seeing, in particular through the media, which is, they've got this blanket devaluation of commercial property, but not all diversified funds are created equal, if you ask me. So
yeah.
I think that's exactly where you're hitting the nail on the head. We're very heavy in industrial, very heavy in retail. We don't have a big portion of office in.
No, and a lot of the media has been around the revaluations, particularly in the bigger funds, but 80% of the pain that's out there is in the office sector, and we've stuck clear for that for a whole variety of reasons. There will be a good time to go back into office, and we're acutely watching that sector, but it's not right now. So, they're the ones taking the big hits. Interestingly, even the big funds that are out there who are having to do the big write-downs on their office, they're finding their industrial property assets are holding their own, and in some cases, if they are going backwards, you're talking about 1%. I think I've seen, or maybe 1.5%. So, and fundamentally, it's simply because we've got the lowest vacancy rates in the world in Australia, or near to. The rent growth is huge. If you look back 6 years ago, I don't think anyone would have forecast the rent growth. We certainly forecast strong rent growth, but nothing like we've actually seen in the market. I don't think anyone would have. So that fundamental underlying strength in that particular sector is holding up those values. So yes, we're not seeing all assets go back in value. I think the sectors we're focused on, local service centres, which is actually in some respects doing better because of COVID, because people are working from home. They're visiting their local service centres more than they previously would, and certainly industrial, because that growth in online and the strength of the economy in general manufacturing and distribution is still going particularly well. So really have seen not too much of a hit in those sectors at all.
Oh, that's great to see. That's really good. I guess the only other thing in regards to, in particular, the diversified funds, but any of the longer term funds, is it's probably not spoken enough about the fact that they are long term and they do survive those short term economic fluctuations. Is that something that we've really looked at?
Well, it's like I was saying earlier, the mining companies, when they're looking to build a mine, they're not looking at what the commodity price is going to be next week or the week after, even the next year, because they know they're invested in this for 10 years and sometimes longer in those sort of circumstances. It's no different to property, particularly on those diversified funds where we're targeting 7 years, whole period for the funds. We're looking through the noise that's out there at the moment, looking through to where do we think these assets will be in that 3, 5, 7 year period when we get past that noise. So I think that anything fundamentally, look, and it's human nature to go, well, what's going to happen next week? I'm really worried. Not as many people can see through that longer term, and I just would encourage any investor looking at our funds and looking at any property investment to try and see through the noise of the short term and look to the fundamentals for the long term. And generally in Australia, we're looking like in a pretty strong space over the next 6 or 7 years, and certainly the industrial sector has still got a couple of good years to run, and we're still very confident on those assets.
Oh, that's excellent. That's really good. You and I both know how research back our company is, but I guess a lot of the investors might not understand how much we actually look at that. But one thing that I know we always talk about in the background is where are the opportunities? Now, you've just touched on that longer term focus, but do you see any other opportunities that are coming out of the economic situation we're in now?
Yeah, right across the whole property spectrum, we're always looking for opportunities to outperform, and that's really important, that you've got to be looking at the long-term trends that are out there in the market, as well as what's happening here and now. Yes, that's important, but it's the long-term trend. So a couple of assets, we went against the I guess what the common themes were out. We bought a lot of assets in the Pilbara, well over 100 and something properties in the Pilbara. And in hindsight, we got them at absolutely screaming bargains. One fund we bought at 25% of the replacement value of that asset. Other ones were buying a whole series of individual houses and properties up there, and some of them have sold for upwards of double of what we paid for them when we sold them a couple of years later. So it's also being cognizant of what's going on. So in construction-wise, we could see the challenges. We pivoted to townhouses, and as we sit here today, they're still looking. Yes, we're seeing some cost increases, but nothing like the commercial sector where that's still a bit more challenging. So we've pivoted a lot there. A lot of our more recent investments have been in townhouses. We will go back into apartments. We think that the market, because the sales prices are so strong and commercial construction costs are starting to flatline a little bit after such a rapid rise, there will be opportunities there. But it's really good. You've got to be on the ground. you've got to be, and that's the great thing, we've got a research-backed team, not just the people out there in the front who are doing the deals. They've got a team behind them doing all that research, and we sit down with an investment committee to make those investment decisions. So we're comfortable that we've got some of the best and brightest minds in the business to help us make those decisions and choosing those assets that are suitable for the period of the return of those particular funds.
Yeah, I rely on all you guys greatly, and I also work here too. So.
Yeah, you're one of those best and brightest, Brett.
All right, well, thank you everyone for your time. If there is anything we haven't covered in the video, please feel free to reach out, give us a call. We'd be happy to discuss and run through it with you. Thank you.